The recent economic data is telling us that the U.S. economy is slowing. Many of the pundits are warning that we could officially enter recession territory later this year or next year. Some of the recent numbers may indicate that it could be sooner rather than later. Yet the stock market has been surging over the last 2 months, and at this point, stocks are off to their best start since 1987. But as long as stock prices are rising, many are simply not going to pay attention to the economic alarm bells that are ringing. Yet, we should be paying attention because some conditions out there are not good. In Friday's update, everything was flowers and rainbows. So today, let's take a look at the dark side. The following are conditions that show the U.S. economy is starting to decline. Farm loan delinquencies just hit the highest level in 9 years. U.S. exports declined by $4 billion during the month of December. JCPenney just announced the closing of another 24 stores. Victoria's Secret has just announced plans to close 53 stores. Gap recently announced that it will be closing 230 stores over the next 2 years. Payless Shoe Source has declared bankruptcy and is closing all 2,100 stores. Tesla is closing all of their physical store locations and will now only sell vehicles online. PepsiCo has started laying off workers and has committed to millions of dollars in severance pay. The Baltic Dry Index has dropped to the lowest level in more than 2 years. This is the worst slump for core U.S. factory orders in 3 years. In January, sales of existing homes fell 8.9% from a year earlier. That was the third month in a row that we have seen a decline of at least 8%. U.S. housing starts were down 11.2% in December compared to the previous month. Compared to a year earlier, home sales in Southern California were down 17% in January. In December, home sales in Sacramento County fell 22.5% compared to a year earlier. Pending home sales in the United States have now fallen on a year-over-year basis for 13 months in a row. More than $166 billion in student loan debt is now seriously delinquent, an all-time record. More than 7 million Americans are behind on their auto loan payments. This is also a new all-time record. The final numbers for 2018 are now in, and the last year was the 13th year in a row when U.S. GDP growth was below 3%. Since 1930, there has been no stretch when the United States went as long as 5 straight years with real GDP failing to grow by at least 3%. Even though the Federal Reserve pumped trillions of dollars into the financial system over the last decade, and even though we added nearly $12 trillion to the national debt, the last time we had a boom year, when economic growth was above 3%, was all the way back in 2005. And lastly, after a bullish stance in January paid off for KK&R and Company, who is one of the largest U.S. private equity firms, KK&R is now turning more cautious. This is a reversal from just 2 months ago when the firm boosted its recommendations to overweight from underweight. KK&R's call is echoing strategies from Goldman Sachs, who has warned the equity rally is set to stall as concerns over a recession and Federal Reserve monetary policy have evaporated. The S&P 500 index is off to its best start in 3 decades, jumping as much as 19% from its December low despite a flurry of earnings downgrades. A spokesperson for KK&R has stated, "We are not bearish, but we do not think the public markets will continue to appreciate in a straight line from current levels if earnings growth continues to disappoint." So, I'm sorry to bring you such dark information, but we gotta keep it real here on this channel. And so for ChewDog Charts, thank you.